Just when you think we're in the clear with a nice supportive Fed, the market starts freaking out about AI bubble fears again. Powell said he's willing to cut rates further to support the labor market, but Oracle said, we're spending more than we're making, and that OpenAI data center may or may not be delayed. Powell said he's turning on the money printer, but Broadcom said, the earnings numbers look good, however, our margins are shrinking. Friday ended up being a pretty nasty down day, but if you've been watching the channel, you know that we have some major support levels below us here. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location, as we always do. In terms of structure last week, solid red-bodied bar with very minimal upper wick and very minimal lower wick. Not much to read into from a psychological perspective there. Pretty weak close from the sellers down towards the lower third of the overall range, but speaking of range, it's very similar in terms of its small compressed nature to the previous week's range, so I'd be a little bit more neutral on the weekly bar. If we're thinking about the bar-to-bar count in terms of location, it's certainly got a nuanced higher low as well as a very nuanced higher high, but a candle closed back inside of the previous week's range. Once again, pretty neutral indication there on the bar-to-bar count. In my view, this really just strikes me as price acceptance, price digestion, consolidation after the major rally that we saw through the shortened Thanksgiving holiday week. Now, recall that rally did come from a weekly higher low, a firm higher low. The all-time high was set, and we did actually flip into a daily downtrend to achieve this pullback here, which is now a firm weekly higher low at or above the weekly 20 SMA. The quintuple bottom low, as we know, is still at 654. So before anyone goes out on a limb and says, oh, look, it's got to be a double top, the market's going to crash, just remember that you actually have to bring in a lower low underneath that neckline for the double top to trigger. Until that actually happens, there's still a chance for a higher low here, there's a chance for continuation in the upward direction, and those two outcomes, in my view, would seem a little bit more reasonable considering that in an uptrend, it's defined by higher lows and higher highs. Well, we just produced a higher low, so what would we think is potentially next in an uptrend? Probably some sort of higher high. So an all-time high breakout here on the weekly timescale would be incredibly bullish, and it would just keep the trend in the upward direction. If we do pull back a little bit more deeply, I would start to think of this as a weekly equilibrium before I would think of it as a topping formation quite yet. We'd really have to drop on the weekly timescale underneath 654 for me to become more concerned. Now, why might I say something like that? If we come in with the Fibonacci's from the low of the move up to the high, we know that the Fib 38.2 is right here. Once again, weekly equilibrium seems a little bit more reasonable than, oh my goodness, the market's topping and it's going to crash and burn and go to zero. If we bring out the anchored VWAP stack on the weekly timescale, we also know that we're above the entirety of the stack. So once again, as we get 2 small-bodied ranges here back to back, really strikes me as being bullish consolidation and digestion over the majority of these reference points that we've been using thus far. What about the weekly volume profile? Any big nuances to pull out of this one? Because we did pull back a little bit last week. Anything big? Not really. Notice that we're still well above this high volume node, and we've basically closed right on this high volume node. Is it possible to use this as consolidation and continuation? Sure. Is it possible to pull back and use this as a potential weekly higher low? Absolutely. So no major concerns on the weekly timescale from the higher time frame perspective, but let's get a little bit more granular here and take it on down to the daily timescale. So the first things first, we'll always start with evaluating this week's expected move. It's this gray shaded area right here. If you're not familiar with this study, check out the video tutorial in the top right hand corner. If we're contained by the upper bound, the number is at 692.85, implying a higher high in the trend count and a brand new all-time high as well. If we're contained by the lower bound, the number's at 670.67, and that would be a major higher low relative to the 1120 panic low in the bearish engulfing bar from then. So the expected move does strike me as being bullish. However, you will notice that the lower bound does overshoot the golden pocket right around in here, which as we know is between about 675 and 674. The reason it's the golden pocket is because it's the top end of both of the bearish engulfing bars from 1010 and 1120. We also have the 20 SMA, the orange moving average on the screen, as well as the 50 SMA, the blue moving average on the screen, both confluence at that 675. So that's the best spot for a daily higher low to form. And speaking of the daily trend, it's possibly starting to pull back here a little bit more meaningfully. Remember that this is the last low in the trend count. This is a soft higher low. We have not achieved an hourly downtrend throughout this entire rally in the upward direction, although one is starting to form as of Friday. We'll talk about the hourly chart here in just a second. But if we were to break down underneath this 679.50, it wouldn't be unreasonable for a very quick move through thin structure to retest the top end of this golden zone that we've been discussing, 675, the moving averages, the bearish engulfer highs. That is a top priority considering this reversal from the Friday session and some of these renewed fears about the AI trade. Another thing I would just point out here is that the market is very deficient when it comes to structure. Why do I say that? All of these lows are extremely precise to the same level. Remember that markets like to end on a bang. Auctions like to end on a bang, not a whimper. You don't see really precise movements that hold for an extended period of time. Major highs are set on huge excess in the upward direction, and major lows are set on big excess in the downward direction. So we could say the same thing about the all-time high here. You've not only got 4 relatively equal highs, all clustered at 689, but it was the opening print of the all-time high bar from back over here as well. So both the top side and the bottom side of this 2-week balance range does strike me as being mechanical and weak, and therefore it wouldn't be unreasonable to put in an excess low here, firm up for a daily higher low, try to rotate back in the upward direction, ideally some sort of higher low consolidation back over that mechanical level at 679.50 for an hourly higher low. We'll talk about the pathing on the hourly as well. And then some sort of move to test the all-time high, which could then hypothetically lead to a breakout that would really encourage the weekly trend to remain in the upward direction. So that's a situation where we pull back cleanly, orderly into this 675. What if there's overshoot of 675? I would not be concerned about overshoot if it's fairly shallow. If we get something that looks like this, maybe tests the lower edge of the weekly expected move, the time to get bullish is back on the recapture and the first hourly higher low back over 675 to confirm the daily higher low. Something that then does this, and then ideally we battle for acceptance back over 679.50. The reason that I would be willing to entertain this idea is because this is the last major low. Once again, we do not have a higher low in the trend count. So it is possible that this overshoot of the golden pocket zone, because, what does the market like to do? It likes to disappoint some people, right? It tends to not do the most obvious thing. It's very obvious, right? Everybody can see the top end of these bear engulfers. Everybody can see the 50 SMA, the 20 SMA. Everybody can see these levels. So an overshoot might not be unreasonable. I tend to not want to be conspiratorial, if you will, about overshoots and, they're out to get you and make it hard. I tend to not lean into that. But it wouldn't be unreasonable if the market did overshoot that, and I'm just letting you know, if we promptly recovered 675, that's where it's like, okay, let's get back in the long positions and let's start trading this market on the bull side, right? That's a possibility there. If the market comes in, it's still possible, right? A breakdown to here to retest this untested high. We do not have an hourly retest of that 668.50 spot. If we come into that, there's 2 outcomes that really start to capture my attention, right? The first one is sort of a little bit deeper of an outcome than what we just talked about, right? So this is still bullish here. But where I would be concerned, of course, is if that does not start to unfold that way, and rather, if we start to show signs of struggle underneath this 675 to produce what would then just become a very obvious lower high, that would probably get me feeling a little bit more neutral into the end of the year, right? So that's kind of a threat that we'll sort of mitigate against, and we'll have this situation in the back pocket. If we do see a major overshoot of the golden pocket and then a lower high under the golden pocket, it's just something to say, okay, into the end of the year, don't expect a whole heck of a lot of anything, right? The Santa rally might be put on pause here as we're just back down inside of what I would argue has been some of the more difficult territory to navigate in this market as of late. So that's the downside outcomes that we can at least visually prepare for here. Now, what we haven't talked about is a little bit more optimistic than that. What if the market completely shrugs off these renewed AI fears and is sort of more focused on the Fed being accommodative, printing money, and of course willing to lower rates if labor starts to deteriorate further? That is a tongue twister. What if we just get a quick repair of this structure, overshoot and come back in? That's technically what? That's a look below and fail on this as an overall range. And then what could potentially happen? Well, any consolidation here then needs to repair the top end of the range, which, as we just described, is technically the improper end of the auction. So then would it be possible for something along these lines? Absolutely. Absolutely. So a higher low Brigade bolt over 689 after repairing the low end of this range at 679.50, that looks pretty darn good. And honestly, I probably should have started with this scenario because I'm not overly bearish on the market. I'm not really looking for this market to crash and burn and, oh my God, that lower high situation is going to come in here and just end the world. That's not my take at all. And although we'll get into the sectors in much more detail in just a moment, I would just point out before we go any further, we're getting rotation, classic rotation. Financials up 2.33%, and then the tech sector down about 2.54%. You're not going to see a market crash. You're not going to see everything going to zero unless all sectors are red and everything is getting sold. And we're just not really seeing that. So I probably should have started with the more bullish outcome. And that right there, what you see on the screen, perhaps let me just say this upside path. Let's label that number 1, not number 2. Number 1 would seem like a little bit more of a top priority to actually watch and monitor for and trade in alignment with. Let's take a look on down at the hourly chart now, just so we can talk a little bit about that hourly trend flipping to down, right? So along the way higher, and this is that Thanksgiving rally back here, clearly just hourly higher lows. But then you built out these hourly equal lows, this hourly higher low shelf in here. Then on Friday, we did actually come in with an hourly lower low. The reason that I'm starting to think about, okay, some sort of overshoot of the bottom end of the range that potentially does this is because the hourly trend is weakening, right? And you can clearly see the intraday lower high happening here into the afternoon underneath 684.50. So in terms of parsing out what could be likely to happen early on this week, seems to me that bear flag consolidation here is just a indication that the market's not quite ready to attract new money buyers into blue sky territories. And we need to shake out some of the longs late to the party. And we've been talking about this concept for a number of weeks now. This grinding move in the upward direction, anybody who continues to try to buy this, they're just starting to feel a little bit disappointed and worn out, right? So where do you think a majority of their stop losses are? Probably underneath these levels in here. If we go bear flag and Brigade bolt underneath, this is kind of how we get that pullback into 675, the golden pocket. Then we're looking for stronger buyers to step up, then reestablish something that looks along these lines. Once again, one of the situations could just be a quick stop run, grab all that stuff, and then something along these lines back to the upside, right? That wouldn't be all that unreasonable. So because we have this little hourly suggestion of a change in trend via lower highs and lower lows, I think it's reasonable to look for that downside snap first early on in the week, and then do the buyers respond at or near 675. We know if we overshoot that level, right, this is that high set that has not been tested, right? This is really thin structure through the rally over here. So this previous area of resistance could act as newfound support. It would be a little bit more of an overshoot than what I'd like to see, but hypothetically, this could look like this. You overshoot to here, you start to rally back off of a V-shaped recovery. The first higher low back over 675 is where I want to start fishing for longs. Please be respectful of the overhead supply on the reattempt. And then when we poke back into that, that's really where I think we go back to the all-time high. That's the situation of the upside. Once again, our back pocket, oh my God, this is not playing out in a bullish way, is if we overshoot to here, lower high underneath, and then we start to crack whatever this low ends up being off to our left. Then we're starting to deal with more of a daily equilibrium. The trend is not cleanly flipping to up, so on and so forth. Let's drop in our Fibonacci's just from the low of this move up to the new high. Just pointing out that the Fib 38.2 is right in the sweet spot there at 675. Let's come in here with some intraday anchored VWAPs. There's really not much to glean from these, if I'm being honest. Let's go intraday. There we go. The entire cluster is kind of underneath us, which is why, once again, I think it's very reasonable. You could get a liquidation break, run the stops, and then come back up into range for something that looks like this. You can see the lower high intraday underneath this breakaway anchored VWAP from here, once again, indicating that it might not be unreasonable for a little bit of downside first, and then seeking the upside once we've either run stops, picked up liquidity, found a daily high or low, whatever you want to call it, doesn't matter. 675, key spot based on all of these indications we've seen thus far. Let's move on over to our, of course, internals for the NYSE. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see here? Was it really all that bad on Friday is the question that I would pose here at the exchange level. Well, volume flows really weren't all that bad. It was not like we had negative 400 million on the volume flows. It's fine. Like, this is just very, very give and take market. You could see FOMC pushed us into trend higher zone here. Nice follow up on the Thursday session. That was nice and bullish. A little bit of give back on Friday. Not the worst thing in the world. If you look at the advanced decline line, it opened in positive territory and was only able to close midway through negative territory. A stronger sell side day would have been a sort of compression of this advanced decline line all day in trend lowers, and it just didn't really happen. Again, intraday, it was a fairly nasty move to the downside. We could see that reflected here by the index score, as well as the cumulative build on the tick, just showing us that a majority of the time spent was under the zero line on the tick-by-tick information. But generally speaking, exchange level volume flow and advanced decline line, not all that bad, as we can see expressed here and as we can see expressed here. So I'll give sellers a little bit of credit where credit is due. I do like the lower high here. I like the fact that there's, finally a lower low underneath this segment. It is possible to get a little bit of a sweep, but am I looking at this market through the lens of, oh my God, we're going to crash and burn and go to zero, the weekly double top's going to trigger, it's the end of the world? Let's take a deep breath. Absolutely not. Let's take a peek over at our market profile for the ES. I would just point out, again, credit where credit is due. If we were going to be more bullish, we ideally should have held up after FOMC in the upper distribution from that Wednesday session. And by the way, if you're not familiar with market profile, check out the video tutorial in the top right-hand corner. So we didn't do that on Thursday, which becomes a little bit more neutral. You could see here on Friday, value definitively shifts lower, right, relative to the Thursday session. The point of control is definitively lower. However, is it really all that bad? If I just zoom out here, remember, all of this is equilibrium. This is like 2-3 weeks worth of trading action here. Value is just unchanged back inside of that equilibrium. So if stronger sellers were really going to come out of the woodwork, point of control, ideally, as we were testing the bottom end of some of these lows over here, should have flipped and continued underneath roughly that 68.10 spot. Just didn't happen. If we go back over to the charts, not the profile, but the charts, that would be here, right? If sellers were really going to make something happen, then great. Into the end of day, let's get this final flush, and let's get the point of control to flip here. It just didn't happen. So although, once again, sellers might have a short-term edge, I think generally speaking, we're seeking a higher low. We're seeking a higher low here. We're seeking some sort of overshoot. Let me just draw this like this, and then maybe like that, right? And this is where we get bullish. This is where we're bullish. This is where we're bullish here. Okay, things will dramatically change if none of that happens, and instead we go overshoot, lower high, sellers, right, head and shoulders, and then lower, back to revisit this low and beyond. So that's the way to plan for this market. Of course, I guess one of the situations I didn't really talk about is it's definitely possible you could go like double bottom, low, low, neckline over 684.50. I think it's fairly straightforward, right? I don't think that we really have to prepare much for the upside. It's more just like, okay, if we get back to here, great, bull flag consolidation, Brigade bolts to blue sky territories really take care of themselves. One thing I will point out now, which I did not point out about market profile, is that we have an unrepaired overnight all-time high. It's very rare, if I just go back to profile, you can see it here. It's very rare that the market will make an all-time high in the after hours and not test it in the regular trading hour session. We've been dealing with this for quite some time in the ES. We finally repaired it, sort of putting in this overnight push, and it's just left again. Like that same day, really Friday's open, did not come in and test the overnight high. So carry that forward in sort of the mantra and the narrative here of the ES, the S&P 500. We have an unrepaired all-time high through the overnight session, and that's at 691.25 in the Spider's cash. If I just go back over here to the ES futures, we're talking about 69.2975. That number is going to change because, of course, this week we do have the contracts rolling from ESZ to ESH, right? So we'll go H26 as we jump into this week. The contract roll will begin. So expect a little bit of volatility there. Means Friday, of course, is going to be a quad witching. Let's get on over to our QQQ cash ETF. Let's see what's going on in the NASDAQ side of the marketplace here. Let's bump this up to a weekly chart and kind of see what the look is. In terms of the weekly bar candle structure, let's throw on those moving averages so we're congruent with the S&P. Weekly bar has a little bit more range to it, but so did last week's bar. Not as much upper and lower wick relative to the size of the candle bodies. Still a weak close in the lower third. I would still argue mostly the same, though, that we are dealing with range compression here, some sort of consolidation after the move higher from the Thanksgiving rally. Not the worst thing in the world. Now, of course, the big difference, as we know, is that we have not yet made it to an equal high on the weekly chart or the all-time high retest. So is it possible that the weekly chart's developing a little bit of a lower high? I think the answer is possibly yes, but I wouldn't be overly bearish, again, until we take out these lows in here, at which time we could maybe call it a lower high double top. But for now, it seems more like weekly trend compression or consolidation, generally speaking, right? You could strike a trend line from the lows doing this, and then now you could strike a trend line like this. So we're compressing in this wedge, and it's hard to say anything overly bearish until one side of the trade actually overwhelms the other. That's either via a higher high on the weekly or some sort of lower low underneath the pivot that we were just talking about. So pretty straightforward there. Weekly compression rather than a straight up trend reversal, but definitely on the fritz a little bit more so than the S&P 500. If we come in here with the Fibonacci from the major low up to the high, what we'll still remember is that all of this action is taking place over over a fib 38.2. So just, again, deep breath for a second. It's not the end of the world. Is it possible that this ends up just being a little bit of a bull flag pennant on the weekly? Of course it's possible. Let's clear that up. Let's take a look at our QQQ anchored VWAPs here, closing right at the top end of the stack, but we're still over it for a majority of the week's price action. Again, it's very hard to say anything overly bearish on the weekly unless we were closed in the midpoint, threatening a breakdown of really this final line in the sand anchored VWAP from here. This is the prior all-time high and the low from the April tariffs anchored VWAP. I mean, they're going to be interesting when and if the market comes in to test that, but I would start thinking more critically about, okay, this is starting to get much weaker than we expect if we take out this anchored VWAP, which, just as a reminder, over the span of time, and this could be 2 to 3 to 4 weeks out from now, it's going to be confluence with this low, right? If it takes us ultimately 2, 3, 4 weeks to get there. So just understand that would just reinforce the sort of narrative that you're just going to want to wait for the double top neckline to break and actually bring in a lower low before you get bearish. Let's come in here with the volume profile just to make sure we're all set on that front as well. Here's the big high volume node. We're still above that one. You could parse this out as a high volume node. It's right where we closed. We do have a small high volume node above us, which is now just acting as the 2-week high. I really don't think there's much to read into there until you're under the major node, which is here closer to about 600. Let's take this down to a daily chart. Let's evaluate a little bit further on the Q's daily. So first up, expected move for the week. Here it is right here. Notice that this is not nearly as bullish as the S&P. Why might I say that? It's not even a higher high relative to the previous week's high, right? We know that the S&P 500 is suggesting a higher high and a brand new all-time high, but the NASDAQ's not even suggesting a higher high over last week's high. You can clearly see here a much more meaningful overshoot of what I would consider a line in the sand for the NASDAQ at 606. Now, we've been talking about this overshoot narrative on the NASDAQ more so than the S&P 500 because of the way that tech trades with a little bit more volatility, right? So the golden pocket ideal zone is this 613, bearish engulfer high, bearish engulfer high. Moving average stack is right there. We started to catch a little bit of support there into the end of the session on Friday. But as we know, the 25K equivalent on the NQ futures or the NDX would just be right around in here, 606 on the QQQ cash ETF. And it's for the same reason as the S&P 500. It's simply because there's still thin structure to get there, but we have not retested on the hourly chart this major high that was established before pulling back that day on the follow-up. So 606, big area on the QQQs, and that's really where I'd be seeking a higher low. So if we overshoot and continue, I'm not as concerned about this on the NASDAQ. This probably leads to a S&P 500 overshoot of its key level. But if we support here, fantastic. I would be willing to either buy the inverted head and shoulders back to the engulfer highs, or just like in the S&P 500, wait patiently for the move back over 613. That's likely an overshoot. Please be respectful of 618.50 on the move back higher here, because now this is going to act as overhead supply. So if we can get back above and reclaim it, that would be the next continuation to the range high here. This is the 2-week balance basically. And that would be the bullish sort of continuation of this move. Of course, the most bullish would just be something early this week that looks like that. It's like rock and roll. There's just nothing to even freak out about. This is clearly higher low on the daily and the weekly for that matter. Although you wouldn't have really flipped into a daily downtrend. So it's a soft higher low on the weekly, firm higher low on the daily. And the reason I could say firm now officially on the QQQ is because this is much more obviously flipping into an hourly downtrend. You've taken out these lows. This is clearly a lower low from here to here, lower low from here to here. And there's a very clear opportunity that any lower high here is just going to yield that deeper pullback. And that's kind of how I would look for the trend to follow through. Okay, so lower highs are a threat underneath 618.50. This will allow the S&P 500 to even get to its 675 spot in the first place. So let's just label this 0.1. The overshoot here gets the S&P into its sweet spot, the golden pocket, and then the QQQ finds support here at the line in the sand at 606. That would be the most perfect, ideal continuation of this higher low pullback. Once again, this is something to have in the back pocket. If we just immediately bounce V-shaped recovery, any positive headlines over the weekend perhaps give us the fuel for this rally over 618.50 early on in the week. Great, we're going to target these equal highs here. Just like in the S&P 500, these are very equal and precise highs, very mechanical. I would expect them to need some sort of repair at some point in the future. It's roughly around 630. If we break that, what's the obvious target? Just the all-time high. Okay, where do I become more concerned about the NASDAQ? It's really not even so much about this lower high here. It's if we overshoot 606, start to do something like this, interact with these lows around 596.50, this starts to become the issue. Now we're just playing ping pong back in, once again, one of the more difficult ranges to actually navigate in this market context over the last 2-3 months, right? So that is the concerning look. Lower highs underneath 606, wave the white flag, dial it back, expectations of the daily trend continuing, really fall to the back burner. I would start thinking about weekly equilibrium and just things not really being solid into the end of this year. Let's come into the hourly chart where we can clearly see once again that hourly trend flipping to down. Here's your balance range above. Here's the breakdown to a lower low, no matter how you slice it. Here's the lower high underneath that range. So once again, bear flag consolidation happens here. This opens the door for the S&P 500 to reach 675. When and if we can support this first target here, Brigade bolt above is great to hear. Please reevaluate on the retest of overhead supply. Pull back for a more major daily higher low would be great. Then the poke through is what you want to get back over 618.50 to navigate back into these highs. If we just immediately go double bottom over the neckline, great, 618.50, retarget the top end of the range. And as we know, like this could be an A to B short. I would short from A to B reasonably because the hourly trend is down. Thin structure retracement here. This prior high is what we want to retest at 606, and that would be the equivalent once again of 25K in the NQ, 25K in the NDX, right? So that is your downside. We've sort of talked about how that might unfold. Let's come in here with some supporting evidence coming from here up to here. Fib 38.2 is kind of what we're resting on. I would say, there's not really much to parse out in terms of like reading into the action from Friday. I would just say that sellers did a decent job. Sellers did a decent job of yielding the lower high underneath the overhead supply. There's a small shift in tone, right? Let's come in here with the intraday anchored VWAPs. Let's continue along. Right at the majority of the cluster, this is like do or die. You're either going to support here and know very early on this week. If the markets look like this, great, 613, the golden pocket's working just fine, longs here. Or you start to consolidate below, you don't recapture 618.50, you drop 613, and that's where, once again, we're open-minded to a short A to B into this level because of the thin structure that exists. Off to our left, we're dropping the VWAP stack. Pretty straightforward there. Let's drop it on over to our NASDAQ internals and see what we get from this perspective. Stronger volume outflows in trend lower zone and a much more meaningful 45-degree line and some beyond negative 6,000 into the close on Friday. Does this make sense that the NASDAQ would be weaker? Of course it makes sense. The headlines all week, or I should say into the end of the week that were concerning, were completely about the AI trade. It was less about the Fed. It was more about the AI trade. Broadcom earnings, Oracle, the whole 9 yards, which we'll get into as we move into some fundamental evidence. But at the exchange level, we are seeing that downside action being supported by some serious sell-side pressure. Let's jump back on over to market profile and finish up our NQ. Let's take a peek over here. Once again, contracts will officially roll. Friday is the expiration, but start watching out for volume rollover and turnover to the H contract early on in the week, as soon as maybe Monday or Tuesday. Value area is certainly lower. It's breakaway to the downside. It's clean to the downside. You do have these single prints, and we have some single prints over on the ES futures as well, but here I think they're a bit more meaningful. If you can reclaim the entirety of single prints, that makes it a little bit more obvious. Perfect. So if I do something that looks like this, if you can reclaim the single prints with a higher low over, let's just call it 25,485, 475, that's where you want to get bullish. That's the equivalent, basically, if I just go back over to the charts here, that's the recapture of this spot at 618.50. This trade right there is the same thing as, if I just go back to the market profile, the reclaim, right, of that 475. If we can do something that looks like that, right? If we rally and reject those single prints, which pretty much start at 400 flat, so you got about a 75-point range to monitor for. If you reject those single prints, that is where you're just staying in the lower distribution. That's where the bears have that edge. That's where I would really be thinking about the deeper pullback into something like that 606, or as we know on the NQ futures, 25K is just a hair below right in here. Okay, that is what we've got on the NQ. Let's get on back to the platform here, and let's take a look at our small caps, which performed quite well, right? Really, really nice looking chart, which we could talk about on the daily. The weekly chart gives us a little bit more of a shooting star here. Let's come in with those moving averages. There we go. So candle structure, location, the whole 9 yards. We do have that shooting star look, but notice that this candle did close green. So that's the first thing to sort of point out. Large upper wick running into some sell side pressure, but brand new all-time highs. Just made a brand new record high, and clearly from here to here, you've got a trend count higher high as well, which means, right, although, and this chart does look like it could use a pullback given that upper wick, what are we seeking? We're seeking a higher low. Just like we talked about on the S&P weekly chart, usually what happens after higher lows is we try to make a higher high. Usually what happens after a higher high is we try to pull back and we try to set a higher low. So it would be very reasonable that breaking underneath previous week's range low could yield something that looks like this. And what do we know is a great spot for a weekly higher low. Now, I'm not forecasting this for this exact week, but the 20 SMA, the bottom end of this weekly equilibrium here, it'd be best if we could stay above for just bull flag and then continuation. But if we do pull back, is it still not possible to form a higher low anywhere over that 240 area? Of course it is. So the weekly chart on small caps actually looks really phenomenal. We've been talking about the monthly for a little while here as well, starting to break out of a multi-year balance range on small caps with a more accommodative Fed supporting lower interest rates, especially if the labor market needs it, as well as the potential, right, to inject capital into overnight markets. So to me, the narrative makes sense with the technical structure. This looks like a bullish chart. Let's go back to the weekly here. Let's take a peek at our Fibonacci's from two different spots. We'll come from the tariff lows up to the new all-time high just to see what this is now aligned with. Looks like we are aligning 38.2 with this. I would say that's monthly higher low at this point. If there was going to be a full-blown retracement to 225.11, starts to look a little bit like a failed breakout on that monthly, but we'll take it one step at a time. Let's come in now from this major pullback low here up to the all-time high. And let's just see where our 38.2 is. Right around that 240 spot, weekly 20 SMA does check out as a bullish supporting piece of evidence. Let's come in with our anchored VWAPs on the weekly. We've got far fewer reference points here, but I think it's very obvious, right? If you do something that looks like this, you're going to pull back right into the top end of the anchored VWAP cluster, which is bullish in the first place. So weekly higher low is very possible near this, let's just call it 238 to 240 spot, bottom end of the balance range. Upper wick here indicating a failure to go higher at the all-time high. Didn't quite close back underneath these prior pivots on the weekly. So it's not like the worst inverted hammer I've ever seen. It's not like sellers really drove prices lower for a close more meaningfully underneath the previous bar's close. You know, it's like maybe some mild sell side pressure, some profit taking as we break out into blue sky territories. Let's quickly hit it with the volume profile before we drop on down to the daily chart and just see what's going on here. So high volume node that we care about is this one. We've still closed above it. It is the previous weekly pivot high from back here. Makes sense. Let's drop it to the daily. Let's see what's going on from this point of view. As we know, weekly expected move is always up first. Here is the gray shaded area, 259.80, new all-time high, higher high in the trend count, and certainly I would argue a higher low here still over that 248.25. Technically, the number is 247.90. The reason I would call this a higher low, right, is for all the same reasons we're talking about a higher low on the ES and the NQ. This is an equilibrium. This is not an hourly downtrend. This is a soft higher low on the daily chart. So if we were to pull back, continue the pullback and sweep that, right? No problem. We could set a higher low here and that's A-okay. This is really, you haven't developed an hourly downtrend at all. This is hardly an hourly downtrend there. You might say that this is a higher low. So therefore, this is still a higher low relative to that. At 248.25, lower edge of the weekly expected move, this previous breakout level, look at how cleanly this small cap chart has been flagging, right? Huge push to the upside. Look at this flag here over the previous area of resistance. Break, holding, high and tight flag, break. If we can hold high and tight over, this would be the most ideal outcome, right? Like what you just talked about on the weekly chart. Over 252.75 is absolutely bullish. Higher low continuation. But once again, given the nature of the give back on Friday, it's not unreasonable that you might get something that looks like this, requiring a firmer daily higher low up against 248.25. That's certainly a possibility right here. The Fed has not undone their U-turn. Right? The Fed is still acting supportive of what the market is sort of requiring, labor support as well as overnight funding liquidity for the private markets, right? There's been some issues with the private markets, as we know, but for the most part, small caps are enjoying what this supportive Fed is doing. So all set on the daily chart. Looks pretty darn good here on the daily before we get to the hourly, because this is just looking insane on the hourly. But let's take the fib from here to here. Fib 38.2, just reinforcing that this zone can certainly act as a higher low. Let's take it now to the hourly chart. What do we see here? A little bit of an hourly reversal, right? Some kind of head and shoulders could be argued for, but notice, what are we supporting above? Previous resistance. We haven't broken that yet. So it would require, right? The short for me on small caps is probably going to look something like this. I'm not short here into the top end of the range. I'm short for either this lower high happening here in the circle or this thin structure underneath this overhead supply, right? Stops get run, thin structure gets retraced, and then we're back down at that daily higher low zone, 248.25. In terms of the bull narrative, once again, this is bullish, absolutely. You could just simply try the long off of this 252.75, retargeting this 256, then the all-time high in blue sky territories beyond that. If we take out the intraday anchored view apps just to check in on the small caps here, what do we have from this perspective? Just not even close to any of the stack. And it's probably worth updating some of this for smalls. Like we could anchor one here. What's this day? That's 12.4. Let's just push one of these out to 12.4 for the sake of having a look. Let's go out 12.04 is good. And let's hit OK. Yeah, right there. Look at that. So this breaking bar, that was a daily breakout. Then going to here looks pretty darn good at 252.75, supporting the thesis that this could just simply be a long, right? You don't really want to be a major short in here. This is a scalp, A to B, and then under B possibly goes to C, but you probably don't want to be a big short at C because of the daily logic that we just talked about, right? Let's just label that C, say congruency. There we go. What else can we say? Let's drop it on over to our Russell market internals and see what's going on from this perspective. I would say this is more so mirror image to what we have in the S&P 500. Mild volume outflow is not bad. Advanced decline line, not bad. Not near trend lower zone. A pretty flat cumulative tick here. It's not like we were pushing negative 1,000, negative 2,000 into the close on Friday, even with the give back that we saw there. Let's go on over to the market profile for the Rusty Russell. Let's take a look at this. Again, nothing we haven't already seen here. Value is shifting lower. Point of control is shifting lower relative to that Friday session. Poor low on Friday could be in need of some repair. I would also point out that you have an overnight all-time high that is unrepaired on the Russell. Of course, the NASDAQ is not even close to the all-time high, so that's not a concerning data point as of right now. But I would remind you, just while we're on the subject of overnight all-time highs that are unrepaired, let me just go to the QQQ and I'll zoom in over here. I'll show you. We do have an overnight all-time high from back here. When we were trading at all-time highs, there was an overnight high that was untested. So that is going to be carried forward, but we're just not even close to using it as a reference yet. It's at 638.80 if you do want to carry that forward. Just, again, on the topic of talking about them, you just want to be fully thorough in the investigation. So that is that. One thing that I would call out here is if you do break these lows, zoom out a little bit. Oh, that's what I was afraid of. All right. It tends to throw a little bit of a temper tantrum here. This trade of 8. So keep going a little bit more. There we go. See this way off to our left? I mean, I'm not talking about a major crash. Oh my God, the market's going to go to zero. This is a virgin point of control. Most other point of controls have been tested. See, this has been tested here. It's like right there on that follow-up session. This got tested the following session. This is also a VPOC. You could carry that forward around this 2470. This one, of course, has been tested. No issues with any of these in here. Tested. This, of course, is here. Tested. No problem. So just two major targets. What I'm trying to sort of illustrate is if the market's gone too far in the upward direction, once again, this thin structure retracement, right, something that looks like this, would just be tagging up to some VPOCs that exist below us, right? Think of it like baseball, batter run, or I don't know baseball all that well. Think about it like, I don't know, hockey offsides is a little bit better, right? The puck goes over, but yet you don't have all your people in play. You got to go back over the line, right? Lacrosse, same thing, can't go over the line. So anyways, use whatever analogy you'd like, but sort of like tagging up, getting on sides, soccer, getting on sides, the whole 9 yards. Let's get back on over to the platform here. Let's finish up our analysis of the broad market basically with the look at the sectors, right? A look through the sectors, who's leading, who's losing. I know we talked about it briefly already, but we are getting rotation. Financials, market, let me frame it this way. Market's not going to crash if financials are green by 233 basis points and the big banks are pushing out to new record highs. XLB is the lightest weight sector in the market, so we don't really want the market pushing a brand new all-time high being led by materials, and guess what? It's not. It's really not. The third performer this week, I should say, is XLP Staples. That is defensive. So I'll give a little bit of credit where credit is due as we are balancing. It's not looking like full-blown risk on, oh my God, we're going to the moon, but financials are at least keeping the rotation theme and thesis alive. Of course, your semiconductors really getting brutalized with the whole narrative of Oracle and Broadcom, down about 3.8%, followed by the tech sector, and then utilities down about 1.27%. Not overly concerned with that. Let's check in on these actual charts. XLB looks great. I mean, this is a fine looking chart. You sort of overshoot, double bottom, high or low, and now you're back to being in that range. It's the lightest weight sector of the market, so I'm not overly concerned about it, but the structure of the chart's fine. It's not at least acting as a headwind to the S&P 500. Financials, once again, how it just doesn't make sense to be a bold, aggressive bear in the market as financials look like this, pushing out to a brand new record high, just going to leave plenty of opportunity for a higher low, really anywhere over, I would say it's probably over these breakout highs, less so 54.10. So you might use something like, I don't know, 53.90. 53.90 could be the big line in the sand. Any higher lows above will keep this trend in the upward direction. Lows, higher lows, some kind of higher low in here on a pullback. I mean, this would be optimal and ideal. Just no concerns about financials yet. Let's go on over to XLP. Staples, starting to stage inverted head and shoulders. It's got to reclaim this 80 spot before I would be like, yeah, oh my goodness, that's, huge bullish action. But at least once again, what is it doing? It's forming some form, of higher lows, which is just not a headwind to the broad market, right? So no issues there. Let's go XLI, pushing out to a brand new record high into the end of the week. Pullback consolidation here looks good. I mean, this is like closer to 8% of the S&P, so a little bit more meaningful. Discretionary, I mean, how about that? Pretty darn good in terms of how equal all these highs are. Once again, that is the improper end of the auction. A quick check back over these prior highs. I don't want to get too level happy, but like any consolidation here or a check back over that then goes like this. I mean, we're talking about an all-time high breakout on discretionary, which is one of the more risk-on sectors in the market. Remember, this is Amazon and Tesla primarily. So that looks pretty darn good here, near the all-time high. Let's jump on over to the XLV, one of the sectors that's really been on a tear recently, ever since September. Nice pullback. I thought that this move into the 150.25 is beautiful. Why? Because we've been talking about this thesis on the weekly chart. I mean, look at your weekly bar there. That's actually quite pretty. But look at your weekly prior pivot. Previous resistance acting as newfound support. I've been saying that weekly equilibrium could be reasonable here after this major rally in the upward direction. Is it possible to build out a range, call that a cup and handle, right? Something that looks like that. And then the next theme could be an all-time high breakout in healthcare. Certainly possible, right? So that's one way that I'm framing that. And it's just really not that bearish. If I just go back to a daily chart, you could argue for like head and shoulders and oh my God, it's going to crash and burn and be the end of the world. But you've got a really strong uptrend behind you and you're looking for a weekly high or low here. So if we get here and if we do this, yeah, of course, this thin structure retracement is absolutely a threat, but we're just not there yet. So I would watch for the lower high. I would be open-minded to this. If we get that breakdown, then sure, right? Thin structure, exactly what I just said. But for the most part, like if we just do this and consolidate and a little bit higher and consolidate, that's that weekly thesis that's really starting to build out. Let's go semiconductors, getting absolutely smacked on the Friday session. Smacked to where though? Pulling back literally from a brand new record high on Wednesday, FOMC day. Great opportunity for a higher low set at the moving average cluster and also over the engulfer highs. There's 1010, here's 1120. If we could stay over the moving average stack, if we could stay over those two highs at, let's just call it roughly 349s, great, higher low, low, higher low, coming from a all-time high, right? Very hard to be bearish on a chart that is in a bullish sequence when it comes to the trend. Now, if we smash through this and get lower high acceptance back here, that's where I would certainly change my tone. I would start waving the white flag a little bit and saying something along the lines of like, okay, not as bullish as we thought, still a chance for a higher low, but you're going to run into some trouble. You would probably reinitiate the bull thesis on something that looks like that. And then you would just start to be a little bit more bearish if we start getting into these lows. Why? Because now you're talking about weekly equilibrium. Weekly equilibrium breaks down, and now all of a sudden we're starting to deal with a much stronger downtrend opportunity because of the weekly break, right? It's one thing here when the weekly trend is still up and you don't really have a weekly break of trend, but if the weekly trend does break with the daily, right, and you could certainly label this double top, I'm sure, right, that's where things really become the red flag. So there's a ways to go before that red flag comes out, but maybe a white flag pending this upcoming week. We shall see. XLK does not look as good, right, for all the same reasons as the QQQ. You can see here, we've got this lower high, and we've pulled back already into this level. Now, the overshoot level to support is still here, 141.25. That's these lows in the prior high that's been untested. If you could support that, then again, you're just sort of in range compression. Let's see if I can bring out the straight edge to not make a fool of my lines there. This one is freehand, though. Pretty good. You're in range compression, so I wouldn't be overly bearish. I mean, it's a little difficult. I'm not going to lie. It's a little bit of a loose chart, a little bit of a sloppy chart here on the XLK compared to some of the other ones we've seen. XLF was fairly obvious. XLY is fairly obvious. XLV, semiconductors. So this one's not as obvious, but I'll be watching for the response here early on this week. If it supports, then great. Just continuing to monitor for higher lows and trend continuation. If we overshoot this and really start to weaken, starting to raise the white flag a little bit. Once again, one of the primary things to pay attention to, does the XLF look good as the XLK looks weak, and then vice versa. If the XLF looks weak, does the XLK look good? So that's what I'll be paying attention to. It's the interplay between those two big sectors that means the most for the market. XLU, lightweight sector, not overly concerned. A lot of people talking about this breakdown here being detrimental. I don't really think it is, right? We could talk about AI data center and sort of the big utility boom that sort of happened on the heels of that here. It was one of the first ones out to a new high. I don't think it's the end of the world. It's just not a heavy enough sector in the market, right? If we just go over here and go SPY, I mean, if utilities were like, I don't know, 10% of the market, I'd be concerned. But at 2.23%, I'm just not sure that it's even worth getting fired up about, right? It's like, sure, lower high, downtrend, sure, it's acting as a little bit of a headwind to the market, but not enough to derail the S&P 500 in its entirety. Let's go to bonds real quick. Big gap down here on the Friday session. Still not really seeing a big uptick in implied volatility. If this can keep going early on in the week, maybe worth some put sales down here, especially if we know the Fed is going to be a little bit more accommodative and cutting rates into the future. This should actually be going the opposite direction, getting a little bit of that long end of the curve to remain elevated on rates, as bond vigilantes basically say, no, give me a higher rate because I believe, right, not I, but bond vigilantes, they believe that inflation is going to come roaring back and they are looking to get paid to take on that risk, aka higher yield. Let's take a look at the XLC. Communications, nice balance range. I would say that this high break would be pretty orderly. This is a clean looking chart versus our XLK, which is a little bit loose. So nice tight range here. Next trade is up and over that high. What are we looking at? Of course, that's going to be your Google. That's going to be your Meta. And Netflix, on the other hand, is possibly looking a little bit weaker. There's the spiders, XLRE, nothing to talk about. 7-month balance range going on 8, nothing to do there. Energy also looking all right here. Nice higher lows, stair stepping in the upward direction, kind of coming into these equal highs. It's not really prone to break out. Energy is a slower mover. Let's look in crude real quick. I haven't seen crude actually break that trend line. Yeah, still in force here, lower crude, which we would think crude might lead the way for rates kind of coming down, which we know the Fed is supportive of. If crude breaks this, you might want to be open-minded to some of the oil names. I would just say XOM is the one to pay attention to because of what it looks like on the weekly chart. Let me just go out to like a 5-year. There you go. I mean, XOM is just, it's really, really range bound here. If it can break out on higher crude, that's one to maybe pay attention to. FANG was another one that wasn't too bad here, breaking out of this range. It looks like the move has mostly been made, though, into that 165. Anyways, quick commentary on energy, but let's get on over to our ratio charts. Let's see if this market's risk on, risk off. If you're not familiar with this ratio chart or how to set them up in Thinkorswim, check out the video tutorial in the top right-hand corner. Pretty much back to a mixed bag here, right? This was looking like, okay, we're perking up here. Not bad. Risk on is coming back into play. Ruined into the end of the week, right? With those AI fears being reinitiated. However, XLF clearly pushing out, making a relative strength move. So I would argue that these might neutralize each other. Kind of, neutral for the broad market, which is primarily our analysis, right? We're thinking about a daily high or low. It's not like we're dealing with momentum breakout where, oh my God, we should be looking at brand new all-time highs. So I think this aligns so far. XLY doing okay, breaking the 50 SMA. That looks good. XLC trying to stage a series of higher lows. So it's not risk off, but it's just not full-blown risk on. And we've been in this situation for a little while now. We know the XLP is kind of like a neutral data point here, and XLU isn't really telling us risk off either. If we look at some of the specialized ratios here, they've gotten a little bit beat up with that end of week rollover in the AI theme. So not shocking, not shocking, not shocking, not shocking. Right? I'd say that still higher low chance here looks pretty good. Higher low chance here looks really good over the 50 SMA. This is still just building out a chance to make a break to the equal high. This looks a little bit more concerning. This has not done anything nice, nor has this over here. So once again, the interpretation is not, oh my God, bearish, we're going to zero. The double top on the weekly is going to trigger and just break everything down. No, it's like we're still dealing with a mostly risk-on market. It's just a matter of picking your spots carefully and really trying to navigate this higher low. Let's go to the B set and just see what's going on here. So this means that gold was breaking out. We know that gold actually had a decent gap up on Friday and then went gap fill reversal for a little bit. So gold performing well, still kind of sending a signal to the market, I think, about inflation. So we look at Bitcoin, it's not really faring well other than just producing more consolidation in the bear flag. So I still don't think there's anything to do on Bitcoin. We have not turned higher through the zero mark on the Sailor Shift tool yet. And of course, the TLT SPY ratio continues to move higher. Risk appetite remains elevated. The big gap down on the TLT will help out with that. Let's jump into our dollar and rates. I was expecting a little bit more here in terms of follow through on the Wednesday session, when Powell really just admitted and acknowledged the printing that's taking place, right? The money printing there. So the dollar moved lower for sure, but I was expecting, at least a test of this 97.75 as we were breaking from, right? This is a reversal on the daily chart of the dollar, double top here. Here's a lower high breaking on Wednesday. And then I was expecting, like I said, a little bit more into that 97.75. Not quite there yet. Rates trying to move higher on the medium end of the curve. This is the 10-year. We could probably take a look at the TYX for the 30-year. Do we have to go CGI on this? I think so. There's the 30-year moving a little bit more meaningfully higher, right? And we've seen this in the bond ratios as well, which I'll just bring up now before we take a look at the Fed Watch tool. I also want to show you a chart of the overnight repurchase activity from the Fed. So this lower ratio here is the longer end of the curve, telling us once again the bond market slightly fearful of inflation based on what Jerome Powell is saying. And we could also go on over to charts, and let me just type in, let's go back on over to the inverted ZT. It's not really telling us much about what the Fed tracker tool should be doing, so no big updates on the Fed tracker tool. If we just take a peek at it, you could see over here that we are just working with a 350 by 375 pause for the next meeting, which is going to be on January 28th. And then as we know, the Fed has only outlined about one rate cut into 2026, but the market is saying no, we might need to get 2 rate cuts. The market's saying basically that the labor situation is going to get worse than the inflation situation. And we can see this in the S&P here, where the Fed has projected inflation to come down to a 2.4. They're expecting inflation to subside in Q1 as the one-time price increase from tariffs passes through. This is what Jerome Powell roughly forecasted during the S&P commentary in his press conference on Wednesday. He said, don't hold me to it, but about 90 days, right? So that brings us to Q1, things normalizing in 2026. And if you strip out tariff inflation, which basically comes from the good side of the inflation ledger, you're at a rough inflation metric of near 2%. Not quite at 2% exactly, but near 2%. Certainly nothing closer to this 3% that we're seeing show up. This is the Fed funds rate, which is forecasting once again only a singular rate cut. This is what the Fed participants were talking about in their meeting, just one cut. And we could see also, if we go over the statement tracker, here's literally what the tension point is, right? The unemployment rate has edged up, and rather than saying remaining low, they just struck that out. And instead, it's through September. The unemployment rate has edged up through September. And as we take a look down at the bottom, we know that we have Super Dove Mirren, who preferred to lower rates by a full 50 basis point cut. Then you also have 2 people who are dissenting for no cut, right? Goolsbee and Schmid preferred no change to the target range, citing inflation and uncertainty in their commentary. If we go back on over to the dot plot from the S&P here, you can actually see that you have a pretty torn Fed, right? Notice how thin this is. A more, what would you say, aligned Fed would have something like this, right? Something here, something here. And we all know who this is, Mr. Mirren, way out there at about a 2.1 on 2026. Cut, cut, cut until there's nothing left to cut. The next thing that I just want to point out is that the Fed, as we scroll down, let's get way down into unemployment rate. The unemployment rate is seen as being now more broadly balanced, and that's why we're getting a little bit less on the cut front. But Jerome Powell said verbally, right, that generally the consensus view is if the Fed feels that labor is being impacted by keeping rates higher, they're not going to be afraid to cut rates, right? You can also scroll down here and see inflation. Many participants now feel as though, no, I shouldn't say many, 2, as a matter of fact. 2 participants are now starting to vote for weighted to the downside rather than in the September projection, right? You can see that most participants thought it was either broadly balanced or weighted to the upside, as a matter of fact. So you've moved a couple of folks from broadly balanced now into weighted to the downside. That's the big change here. What does this tell us about the Fed? They're less concerned about inflation. They're more concerned about the labor market, which means they will be supportive of lower rates. And also overnight, we sort of learned based on Jerome Powell's commentary, they are willing to inject capital, basically. I think that they were saying monthly, it's between about, I'm going to have to go back and find it. I think it's more than 20 billion, but about 20 billion being injected into the overnight repo markets there. Let's get on over to the calendar. What's upcoming this week in terms of Monday's session? Empire State, not really a big deal there. A lot of delayed data will be released on the 16th. You can see primarily it's the labor report that we're concerned about. Jerome Powell mentioned that the Fed revises these things down by about 60,000 jobs. So if we hit the forecast here at 50,000, really the Fed's going to view that as a loss of about 10,000 jobs rather than a on-the-money read of 50K. We will also get the unemployment rate scheduled to tick slightly higher at a 4.5, it looks like. And then I would say intraday, the manufacturing and services PMI on the flash side is always more important than the final that the S&P releases. So we'll watch that as the intraday catalyst on Tuesday. CPI coming out on the Thursday session's an old read, I believe. Yeah, release delayed 8 days due to the government shutdown. So what report is this ultimately? Is what we care about. That was September. So we're probably looking at remember there is no October, the November inflation report is going to be coming on the 18th here. We'll get CPI, and I don't know why these are tentative in terms of timing. But anyways, a lot of delayed data coming this week. That's the main point. The market's going to learn quite a bit about inflation and the labor situation as we move through the midpoint of this week. And that will act as a catalyst, right? As we've seen, and something to just maybe connect the dots on, is the market's been very balanced over the last 2 weeks, right? And why might that be the case? Because there have been no fundamental catalysts. We have not seen a labor situation. We have not seen a CPI report. We have not seen any of these data points that we know the market keys off of relative to infer what the Fed might be doing in the next upcoming meeting. Are they going to be more accommodative? Are they not going to be more accommodative, right? So that'll be interesting. I do believe that we are likely out of this consolidation range. If I just go back on over to the charts here for just a second, let's go back on over. Let's not let that thing spiral out of control for forever. We'll bring up and edit in that Fed overnight data point. But this balance range, I don't think is going to last. I think that we are on the heels of breaking it in a big way, whether or not it's just cleaner movement that looks like this, right? Whether or not it's this. Like, all of this stuff is okay, but I think that we are going to get more movement than this sideways consolidation now that we are about to get a slew of economic data, and we're getting AI to be sort of reinitiated in the headlines as a talking point to fuel volatility, right? And that's kind of like, as a trend trader, that's what I would like to see in this market to actually get the job done and be able to do something intraday with the market. Just trading this range, not all that exciting for someone with my particular strategy. Long-term investments, yeah, great, awesome. We'll continue to track the market for that, but active trades bring the volatility, right? Let's take a peek over at where were we? We were still working through the earnings side of the equation next. We can see this week it's probably all about Micron. As I flip back to the black crayon, there we go. Micron is what we care about on Wednesday after the close. I would say FedEx usually has some sort of insight for the economy. They sort of had their one moment. Maybe we'll give them a Michael Burry Award when they were talking about the 2022 slowdown, but they haven't really done anything more meaningful since then, in terms of a big call at least, shall I say. That's really it. That's what I would pay attention to here. Micron is the top watch, maybe FedEx as a back pocket, and then we'll just be waiting patiently for financials midway through the month of January, once we turn the calendar for the new year. Earnings insight, I do want to bring up that forecasts for Q4 of 25 are slightly lower than Q3. And typically when we see this, we get a little bit of volatility in the market, right? Typically, market tries to follow earnings estimates, or the market is trading off of some valuation metric. And notice how this is a little stagnant here. Is it unreasonable that the first half of 26, right, because Q4 earnings won't really come out until we're into 2026, is it possible that 2026 first half is marked by some volatility? I mean, yes, don't forget that the weekly chart, and I'm just sort of like going back to a higher time scale now, don't forget that the weekly chart has been on a tear since the April lows, right? I think this is a 41.25% move to the high. 43% move to the high. It's huge. Like, that's a pretty large move here off of that low. It wouldn't be unreasonable for like some sort of digestion. We've been, I don't want to say fooled or tricked or anything like that. It's just always, it is what it is. But we've been sort of given this nice trending market. Markets don't move in a straight line forever, right? This sickness era has really conditioned the mind to think that way. But if you just go back, I don't know, maybe back over here, you get some pretty volatile moments in the market. This, of course, is the big sickness drop. Pre-sickness, this is like two-sided trade all here through 2015, right? And what do we know about 2015? What do we know about this period in the market, right? What was the administration doing, right? Anyhow, just some broader commentary here as we're thinking about higher time frame events and, generally markets trying to follow earnings estimates here. So that's covered on this particular front. In terms of just giving you the data points, Broadcom tumbles 11% despite blockbuster numbers, right? And why? Right about here. Analysts see Broadcom taking a significant margin hit in the short term due to its costly buildouts, right? It's all about this buildout. What does the market not like? The market doesn't want to hear that you're spending any more money. The market does not want to hear about any CapEx, really. And what did we get from Oracle, right? Oracle said, maybe we will, maybe we won't build out this OpenAI data center. There was some pushback and saying, it's completely on track. But like, these things aren't really going to, you're not going to see these headlines just for the sake of seeing these headlines. I think that there's definitely some conversations behind the scene that are like, we are kind of spending more than we're making. That's what they said in their earnings call. So just to give you an idea of where this concern about the AI trade is coming from, it's about CapEx, right? It's all about CapEx. If any of these companies start announcing more CapEx without seeing bottom line increase, it's just not really going to be, it's not going to be well received by the market. That's as straightforward as it can get. So as we're thinking about earnings, Micron is the one that looms, and Micron, of course, is crushing it on memory. So we'll see if they have positive things to say about that. I'm sure they will. But make note of anything said about CapEx. That's it, right? Is our company CapEx increasing? Not for Micron itself, but people spending on Micron to build out these data centers and these particularly, memory being the next phase of AI and this recall. Is that going to be a stronger push going forward, and who's spending money on it, and do those stocks get hit? That's the way I'm thinking about that from a fundamental perspective. So that is what I've got for us there. Let's go back on over to the platform. Let's finish up with some supporting evidence. We already looked at bonds, so we'll go straight into credit spreads. A little bit of an uptick here happening into the end of the week. Small pressure and volatility. I think it makes sense given what we saw in the S&P 500, as well as some of the commentary bits about private credit and Jerome Powell trying to save the day with the overnight funding. If we jump into junk bonds in isolation, I would just point out, let's go on over here to the SPX. We have seen a bearish divergence again. So strip out the dividend gap down, which is this straight line here, and just take a look at this pivot high to this pivot high. You get a lower high in the HYG versus a higher high in the SPX. So the divergence strikes again, and I would continue to pay very close attention to this and not let it lead you astray. So what's the next big watch? Well, if the S&P 500 starts to take out these lows and the HYG does not take out these lows, we'll play the bullish situation first, then guess what? Don't chase this short. If the HYG takes this out, and the S&P is still going sideways, play the short, right? And that's the way I would be thinking about this next sequence for junk. Let's jump on into the breadth of the market, seemingly improving through the first half of last week ahead of the Fed and on the Fed. A little bit of a mild check back here into the end of the week. Let's go on over to the RSP full screen, or just an easier comparison. New all-time high, pulling back, very reasonable, right? Brigade bolt here over the bull flag, no problemo over 192.25. Let's take a peek over at the equal weight NASDAQ. Still looks good over here, making much more of an equal-ish high versus the lower high on the NDX. It becomes a little bit more obvious when I point it out like this. It's still lower. Don't get me wrong. It's not like perfect, but it is much closer. So broadening out of the market rally continues to be a bullish narrative. Remember, we have two themes driving this market. Number one, supportive Fed. We'll go SF instead of FU for Fed U-turn. Then we also have AI trade, right? AI trade being Michael Burry's concerns going away, but now that's being brought back into question. We don't have Burry this time, but the data center and CapEx spend back in the limelight. Let's continue along here to volatility. A little bit of an uptick, but if I was thinking, oh wow, this is it, the market's going to crash and burn, vol is not going to compress like this into Friday afternoon. It's going to remain elevated as people go out through the weekend saying, I want insurance. I want insurance. I don't want to be left exposed over the weekend. Let's get this thing ramping. Didn't happen. Look at the close here. Pretty weak. Look at something like the VVIX, right? Take a look at this. Rejecting that 103 on the Friday closure. Again, if people were going to go out all concerned this weekend, oh my goodness, give me insurance, this is going higher and it's closing strong. Go take a look at something like your vol futures. Yes, it backed off a little bit, but still in a deep contango. These would be inverting if people were buying insurance over the weekend, right? And you could, of course, always make the counter argument. Market's always two-sided. We could have this conversation. Well, the market's most susceptible to the largest downdraft when nobody has insurance. I get it. But in terms of participant sentiment, there's nobody, or at least it doesn't seem like yet, who is so bearish that, oh my God, I'm going out over the weekend, I'm selling everything in the S&P 500. If that was the case, then we wouldn't see financials green. And, I'm selling everything, and I'm also buying and holding major insurance. It's not there. The ingredients aren't there. So that is what we've got through the supporting evidence categories. Let's rip through the core list of companies. And then I've got 4, actually, trade ideas to share with you. Not just 3, 4. I just don't like drawing the number 4 in the intro there. What do we have on NVIDIA? It's pretty tough to say anything constructive about this chart. It had one opportunity to maybe break these hammer highs on Thursday, Friday, and do something that looked like that. Obviously, with the Oracle earnings, that just wasn't even in play. So Complete pass on NVIDIA. I think that this is the trade to watch for, the thin structure retracement, if it does get back in gear. But for now, what do I do in this range? Probably not a lot of anything. Probably not a whole heck of a lot of anything. Why? Because you've got this low to contend with, this low, these lows, this. It's not a very clean chart to be trading in here. If the momentum really picks up and it's just like a knife through hot knife through butter, there we go, room temperature butter perhaps. But if it's completely a fall apart, maybe there's some sort of watch here around this 160 area. The daily 200 could possibly catch up, but it's not been a great trading chart. It really just hasn't been. If you look at the hourly, right? I mean, you open right here, you test that one, or sorry, the open was even higher. You open here, you test higher, and then fall apart. It's a pretty tough short, right? After failing to go higher, then shorting it after you've already made a substantial move. So, I mean, there's a lower high here for sure at or near the low of the Thursday session. It's probably bearish in the short term, bear flag consolidation. You could probably trade this as scalps from A to B. But is this the most confident daily chart? Absolutely not. Absolutely not, for all the reasons we just talked about here. Apple, on the other hand, chart looks fantastic. Look at the Friday bar after the Thursday overshoot of the 20. Another little resting bar inside this range. I would prefer that after this little wick, we start to test higher, right? Why does this make sense? Because if sellers were really going to materialize here, you should have expected a weak close on Thursday and then follow up on Friday, testing the 50 or, just falling deeper into this range. Not happening. So buyers are stepping up, and this is the next Brigade bolt to the upside. Apple has been in a much cleaner uptrend across the board versus something like your NVIDIA. So I think on this, the big watch is like, does this just turn into inverted head and shoulders over the neckline? Let's rock and roll back to all-time highs. I do have a swing long position on, so take my analysis as being biased, if you will. I'll have to adjust my position if we start to really accept here underneath this 276.50. 20 SMA is continuously creeping up, so got to continue to either surf that 20 and break to the upside, or just start to reassess if we're underneath that zone right there. Let's move along to Microsoft and see what's happening. Another one, I have a swing position on here, so take the analysis with a grain of salt. It's a bullish swing position. I would prefer that this area of support held in here. Still just trying to play this, generally speaking, off of a 200 hold, so now that that's covered, this is more of a balance range. The trend is not there. This is not a constructive chart for my long. I do not like the inside candle from that Friday session. It seems to me that a Brigade bolt underneath that is just a bearish 3-bar play, targeting at least the 200, if not these equal lows here, which is the weekly pivot at 468. If I go to a weekly chart, let me remind you that the whole thesis of this long trade is that I believed Microsoft was going to use the rock, previous weekly resistance, as support and be able to overcome the hard place, which is the neckline of the double top happening over here. Looks like as of right now, the answer is not quite ready for that. And as of right now, this absolutely is a bear flag. So I can see that bearish component of the analysis. And I think it is possible to trade shorts underneath. I could trade an intraday short position under 476.60 into this level. I would say all hell breaks loose, and I would get really, really bearish on Microsoft if we cannot hold this area here at 468 at all. If we drop it on down to the hourly chart, just consolidation. Just consolidation. The one thing I might say, if I'm trying to, pat myself on the back, make myself feel a little bit better, range compression here on Friday rather than a sell-off. Right? What did the broad market do? The broad market was down about 93 basis points. Microsoft's down about 30 basis points and going sideways, not really trending lower intraday. So, some degree of relative strength. I don't want to take too much of a stretch, but perhaps, right? So if we can continue to hold here, that would help the swing position. I'd like to see the gap close. I'd like to see this top end of the range. I'd probably start to become a seller of a portion of the position to just trade it as a range up here and then try to monitor for continuation over that, adding to it if we were to do something like this into the future. We're just not there yet. Don't want to get too speculative before the move actually happens. And as a matter of fact, just to recenter myself, probably going to be pretty defensive early in the week on Microsoft if we find ourselves here on a break below Friday's low. Let's continue along. Amazon. It's the third in the trifecta of positions that I own. I own this one off the daily 200, so not as concerned. I've already taken a trim here, willing to continue to just babysit this basically. What's next for it? I mean, definitely lower high, being on the weekly chart from here to here. Starting to look like even from here to here, a lower high on the daily. So double top, if you will, 1, 2, neckline break under 227. Certainly possible to get back to the daily 200. That would just sort of be range ping pong in my view. If Amazon can undercut and sort of save this 227, we call it look below and fail. Some people call it undercut and rally. Then your double bottom neckline will just turn into that lower high at 232.75, right? And then that is ideally what you get back into this 238.75. If we go on down to the hourly chart, what I'm not fond of, and again, I have to play defense on some of these positions, is this bear flag happening under 227 into the close, right? If we had stronger buyers, ideally it's a look below, fail, higher low into the close, setting up, maybe this is the close of Friday, and then Monday, some sort of open over 227 rallies back into this high here. Not really getting that, and for now, it's taking it day by day and being open-minded to having to adjust or just close the position for a small profit on what remains of it if we are starting to fail that 227. Because ideally on the daily chart, this is where we should step up. If this was going to be inverted head and shoulders, this wanted to be higher low, break through this, just not really seeing that. So in the nature of sort of managing against a base case, I think the base case starts to get threatened as we accept further underneath 227. So that's the big bear line. Let's continue along to Google. No more positions to sort of give you a bias on, so flat everything else. I just like to say it when I do have a position in case it is influencing the bias of the analysis so you can judge for yourself. Okay. Anyways, whatever else is going on with Google here, I would love to get long Google, right? Don't have a swing position here. I would be willing to put one on. If we can hold this daily 20, if we could break over that Friday high, something that looks like this, range rotation, break of the trend line, something that tries to navigate back to an all-time high, possible. It's a new AI leader, strong daily uptrend behind us. Does it need this weekly retest here? Maybe. So just watching very closely to see how this range resolves. For now, starting to get support here on that Friday session near the daily 20, near the sort of gap that's unfilled from here. I'm just going to continue to monitor that, really. 304, key support. If we stay above, great. Over 310s, really looking for an excuse to get long over Friday's high, then getting something into the top end of the range here. If this really starts to falter underneath 304, I'm probably not short through this. That's a little bit choppy there, but I'm more so just interested in does this pick up for a weekly higher low at 291.65. Moving along to Broadcom. Absolutely hammered on the Friday session there post earnings on Thursday. Not just a gap down, but then continuation underneath the top end of the balance range from back here, killing the daily 20, killing the daily 50. Got no dog in the fight, but the chart's just going to get ugly back again inside of this range. So I'm not too fond of trading this in here. If it can snap out of it quickly and do this, right? If we can go V-shaped recovery, bull flag, and then continuation for the gap close overhead, I'd be willing to trade for the gap close on scalps and such, but I don't know about doing anything big bold off of this midpoint of the range here. So really need to let this chart develop something new. It's got a big new high volume close based on earnings, so you could use that as an over-under. If you're over or under 358.25, you could start to build a bias. If you're above, then great. Anyone who shorted this into the close looks like they're getting steamrolled. And once again, the long is probably here and then here. The action item is over 382 for the gap close. The other thing would just be if you do this and then fail that, right, then it's through the high volume close as an H pattern lower high, looking for continuation towards the bottom end of the range, under 358.25. Moving along to the metaverse, not really a great looking chart, I don't think yet. You've got sort of like cup and handle, I get it, but you're still underneath the daily 200. You're rejecting the 200, you're rejecting the 50. Doesn't look all that great. I mean, maybe you could say the 20 is going to be supportive below, but there's a lot of work that needs to be done on this chart before I would start to get bullish on it. And as a matter of fact, I would think that this is a better watch early on in the week. Do we drop this? We know that Meta has been one of the worst offenders when it comes to CapEx. So anything underneath this 637.50 as this comes back into the limelight as an issue, it's probably a short through this thin structure, I would think, into some of this consolidation down here at 604. Right? So Meta could be an early week short. If you take a look at the hourly chart, I think that head and shoulders is very obvious, right? Something that looks like that. Can we do this through the thin structure? Right? That's the big watch, 637.50. Moving along to Tesla. Tesla, on the other hand, looks fantastic. Tesla looks great. You could look at it on a daily. You could look at it on a weekly as well. Let's go weekly chart here. Is this not just a major cup and handle? I think it is. It's failed to go lower here, right? Sellers could not retrace this thin structure into the breakout point. We're back inside the cup, inside the handle of the cup. We're approaching the top end of the range. And I would honestly say on a daily chart, I would have expected a little bit more of a fight at the retest of this level here. The market smashed right through and is staging higher lows above. So Tesla looks pretty darn good on the hold over this 441.25, 50 SMA, 20 SMA. Any, daily looks like it's starting to break and close over this. And keep in mind, what's the backdrop of the broad market? Does this have relative strength or relative weakness? Huge relative strength, right? The broad market's lower into the close of Friday, into the close of the week. What is Tesla doing all week? Working its way in the upward direction to close over that previous resistance. So, I don't think that Tesla is one to miss here. I think Tesla is looking good on a weekly, looking good on a daily. Next phase would just be consolidation here, gets real tight, and any sort of break up and over that 470.75 top end of the flat base, right, builds out a little bit more of the right-hand side of the base, and then it goes. That's a long to sort of participate in, right? This is one of those moments on Tesla. Everybody can see it. Everybody knows it, right? Might take a couple of paper cuts here as it starts to look like it's going, but you got to make sure you're able to take the actual move when and if it does start to develop. So don't get too hung up on getting it long here, getting it long here, trying to buy the pullback. it'll do whatever it's going to do to build out the right-hand side of this base. I think where you really need to make sure you're able to get involved. Again, no guarantee that it works out, but I would at least be willing to take a big crack at Tesla, take a swing at it when and if it's up and out over 470.75. All right. So that's that. Hourly chart looks pretty good. Look at the strength here into the close versus the broad market weakness, right? Let's move along to JP Morgan. Banks have looked fantastic. JP Morgan's actually the laggard. We know that they had that debacle on the, Tuesday session when they said clients are being a little bit more, quote, discerning. Anyways, this looks good. Just like balance range, possible breakout. Look at any of the other big banks. Citibank, huge move, pushing out to new all-time highs here. You could go WFC has been a favorite in the group, right? Nice bull flag here, breaking the new highs. That looked awesome. Goldman Sachs, as we know, finally getting in gear after their large M&A feedback there. Let's go on over to Morgan Stanley. Looks fantastic here. I'd say Bank of America is a laggard, just like JP Morgan. It is starting to break, but it's not nearly as strong, of course. So, as we just go back to JP Morgan, the reason this one's on the list is because it's such a heavyweight representation in the S&P. I mean, the chart looks good. Any sort of higher low and then continuation into blue skies, it's going to continue to keep that rotation afloat for the market, and I would not be an aggressive bear. Palantir, what do we have over here? Back-to-back-to-back lower wicks off the daily 50. I think it's trying to build out a little bit of a flag here, something like this. It's a little loose in terms of the width of the ranges. It's not really tightening up yet. I'd like to see maybe a tight inside candle here relative to this as an overall range. So tighten up and then a break up and over. Probably looking at the overnight high from the contract that was awarded. I think it was a Navy contract, right? 500 billion or million. Check my numbers there. But big naval contract awarded. That overnight high is untested. These prior highs are untested. So if we can break out of this flag, that's kind of the target there. Any consolidation in here keeps it in play. That's fine, right? Staying over the 50 looks pretty darn good. Here it is on the hourly chart. You could maybe argue a little bit of head and shoulders, fine. As long as we're over this level, I wouldn't even think twice about shorting it. Let it consolidate, let it balance, let it do whatever it wants to do. When and if it does that, as long as it's still over the 50, right, and by virtue of being there, it would have to be, over that, that's where I want to get involved on Palantir. That is 187.25. Right, daily bull flag breakout. I'd like to see a tight bar and then the next break, something that looks like that. Let's continue along with AMD. AMD actually giving it up more firmly underneath that 214.35. Should have saved the short from Thursday and done it on Friday, but nonetheless, getting the breakdown that we've been waiting for, right? That's what we've been watching for. We participated once, and we'll see if we can participate again on continuation into these equal lows. So AMD looking weak here on a major lower high underneath the moving average stack, 50 and 20, both pressuring it to the downside. If we take a look at the hourly chart here, you can start to see that lower high developing under the flush point, 214.35. So little H pattern there under these equal lows. You have more thin structure to retrace. That'll be a top watch early on in the week if we need shorts. So, Tesla looks good on the long side. Google looks good on the long side. Apple looks good on the long side. AMD looks good on the short side. And Meta looks good on the short side. So those are sort of like the top priorities, just given what we know so far. If we look on over to Robinhood, I'd say Robinhood's a little bit more indecisive, shall I say. It had a really nice looking push here, completely falling apart. Got caught a couple of downgrades on that Thursday session. And now is closing underneath this daily double top neckline, 1-2 neckline, right? So not as good looking. It took a pretty big beating there. I think it was down like closer to 6% on the Thursday session. I'm open-minded to start selling puts to initiate a swing trade on Robinhood, ideally selling something like the 85s, the 80s. If this can continue to extend to the downside, I want to be selling underneath the daily 200, looking for some sort of, if it gets there, relief rally, then covering on, 50% of premium received or something of the sort. So you get the idea. If implied volatility can pick up, if this gets a little bit more bearish into this area, I'm going to be selling puts in here as a swing idea. The next thing to focus on would just be if this recaptures this area here, then we're just in like an equilibrium, right? It's not really cleanly trending. If it was, you would hold a higher low, and maybe that's just ultimately it on a higher time frame, but you also still have to contend with this, right? That's kind of a problem right now for Robinhood, clearly. The weekly chart looks great. Right, really no issues on the weekly. I wouldn't quite call this head and shoulders yet. I'd need to see a much bigger deterioration to get here. Then I would start saying head and shoulders maybe. But for now, if anything, it's like flag at the top of this move from that perspective, right? Hourly chart we looked at already, so now it's time to get into these additional ideas. So the reason I said 3 in the beginning is because 2 of them are very closely related. It's Eli Lilly and AMGN. So in the healthcare/drug making space, you can see this inside candle on Lilly after a beautiful linear pullback after this linear move in the upward direction. So it's going counter, or I should say the counter trend move here, backside of the move is broken, and over these 2 equal highs over the 20 SMA, I don't want to say you're going all the way back to this high, but it would seem reasonable that this thin structure retracement, let's get a zoom, there we go, can build out. Here it is on the hourly. So a break over 1031.50, trying to get some lift here back up towards this high set. You can maybe parse out I would probably call for something like this, where the market struggled a bit. That could be a dim gray level if we'd like. At 65, we'll call it for round numbers sake. We'll dim this back, dotted, great, fantastic. Something like that could be your first target, then trying to monitor for continuation here. If it does end up setting a lower high, please be respectful of the backside of the move continuing. But for now, that's like sort of a top watch. And you might get something that looks like this, right? Why do I draw that in particular? Because 20 SMA, right? 20 SMA rolls a little bit, starts to flatten. If you can hold that on a reclaim, that would be, classically, a lot of people online would start calling for an undercut and rally. Right, nice pullback, undercut the 20, reclaim and rally. Sure, all-time high target. Okay, so that's Eli Lilly. The next was AMGN, AMGN. Beat up a little bit more. Let's go to a daily. Why do I like this? Holding the 50, getting tight. I mean, you could certainly say bear flag on the lows after failing this overhead supply, but look at this move. It's retraced to the breakout point. This flag from back here. I think that this is a possible long out of Friday's range through some of the thin structure retracement, even if you can only target the bottom end of the range there. Let's go on down to an hourly chart and get a little bit more granular with some of these levels. Let's go 334 as a round number. Perfect. And then in here, I mean, we're talking about a move over 319. I'll dim this back as well, just because the thin structure on the breakdown here didn't really respect it. That's why. Let's come in with a 25 on this. We'll be fine. And that's it. So something over 319.25 holding the daily 50, you're starting to go counter trend against this hourly downtrend, but in alignment with the daily trend, right? So that's what I like about AMGN here. And once again, that's sort of one and the same, which is why I said 3 in the intro. Next up, we have Frog. Frog. Nice breakout. Nice breakout here over the 65 handle, and now getting tight on a first flag out of the range. So, I mean, looks pretty good. This was like a nice compression. This is a consolidation here. First flag out of the range, high tight flag. If we can move over these highs around like 70, looking not bad into, let's see what we have for resistance above. It could either be all-time highs or we have a little bit of weekly resistance above. Let's go way out on this thing. Let's go out here. Yeah, what's this? So break of that, and then I believe, let me just make, yeah, that's the IPO open back here. I'd say IPO opening print could also be a reclaim. What is that? What is that? That is at 71.27. What a weird IPO open, but that's technically it. All right, on the money. And then this high is up here at 95.35. So, be cautious of buying something extended however many percents this is up. It's coming from like, I don't know, maybe this low. Up 55%, being a brand new buyer here for anything more than maybe just a scalp. Be mindful of that, but the chart setup does look good on the daily here with this little tightening configuration after a break over this high. I'd say on pullbacks, you just want to maintain over 65. Let's get that level back in. It seems like my frog chart got reset. I could have swore I had levels here at 65 already. Anyways, that is it. And IPO open. I'm going to give that a label so I don't forget. Thanks for working with me in real time. IPO open. And those always go pure white. And let's go with a width of 2. Ooh, there we go. Oh, label. Why is the label not on? Because I didn't turn it on. There we go. All right, IPO opening print frog. Next up, IREN. IREN, there we are. IREN breakdown short, right? Double top happening here. 1, 2, neckline. Underneath the neckline, consolidation. If this was going to be a look below and fail, you needed to go right here. Right there is when you needed to do it on this follow-up session. And of course, not happening. Inverted head and shoulders did not play out. Now instead you have descending triangle. Oops, let's get a straight edge, please. Descending triangle, lower highs, flat lows. Pretty classic setup. This, I mean, you're just talking about some deterioration here on IREN, a lot of overhead supply. Why is this also an issue? What does the market not like right now? CapEx. What does it not like CapEx on? Data centers. Okay, so IREN, there you have it. You could probably say the same about NBIS, but this is cleaner on IREN. Why do I say it's cleaner? I think for obvious reasons. It's got much more of a flush point, but here's your lower high underneath, loosely at the double top neckline on NBIS. And speaking of data centers, sending them into the sky. Oh boy, let's take a look at Rocket Lab, right? This could be a pullback long. This is not something I intended on including in the trade ideas, but Rocket Lab over this 5350 could get interesting. And then ASTS is the other name, of course, that's really been a beneficiary of this kind of narrative here. What would the pullback level be? I'd want to see it hold the 50 around 70.85s roughly. And this is just a very sloppy and quick chart, but you get the idea. Any consolidation for a flag, all-time highs back over here on ASTS. All right, so thematically, be thinking about that. The other thing I'll say thematically is, and we're totally just digging deep into the mental trenches right now. There's an announcement about cybersecurity on the Friday session and executive orders being signed along those lines. Palo Alto is probably a front runner in this idea just because of its weekly chart. Look at its weekly, nice trend, holding up near all-time highs, lows, higher lows, pulling back from a higher high. I wouldn't be as interested in something like an FTNT. Right, you can see how this is off with a lot of overhead supply. It does have this big gap to close overhead, but it's not as clean. So Fortinet, it's a little tough for me to say anything constructive about in this range. Then you might go on over to something like a CrowdStrike. Of course, CrowdStrike seemingly a bit head and shoulders-esque. Not as good as something like a Palo Alto in my view. The weekly chart's not really as good as either. Let's go out here. Actually, maybe it contends. Yeah, it contends. I'll give a little credit to CrowdStrike's weekly. And then Rubrik, RBRK, another one here. Couldn't really get in gear post earnings. Let's go back to a daily chart. Kind of gap in, we call it a gap in crap classically, but couldn't really hold up. So not in love with it, but this theme might be something to put in the back pocket and expect maybe some announcements as we move into the next couple of weeks, just purely based on the idea that a executive order around cybersecurity is basically right around the corner. Okay, so that is it. That's what I've got for you in today's installation of the weekly watch list. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. As always, we'll be live at 8 a.m. Eastern Time on Monday morning for another episode of the Pre-Market Prep, where we build a real-time game plan according to whatever is going on that morning. So if you want the latest and greatest, come back out to the channel on Monday morning. We hope to see you there. Also, a big thank you. Really big thank you. I know Thanksgiving has come and gone, and it's not a Thanksgiving thank you, but it is a thank you for 200,000 subscribers. I mean, in what world did I ever think just posting some financial analysis ideas online would ever lead to 200,000 people being interested in what I have to say? So huge thank you for everybody who's been a part of it. And I guess here's just to onward and upward, right? Get into the next, milestone. What is it? 250,000, 250,000? That's pretty cool. So once again, huge appreciation to everybody who shows up to the show, is here week in and week out, day in and day out with those pre-market prep episodes as well. I appreciate all of you. Hopefully hopefully this information is still useful and helpful in your analysis, your preparation for the week ahead, the market ahead. And if it's ever not, just let me know in the comment section. And maybe it's time to revamp what we do here around the channel. But for now, it's been a pretty good routine that I've fallen into. I enjoy it to prepare myself. And if sharing it with the world is going to mean that some other traders have an alternate perspective to consider also, then fantastic. And that is just phenomenal. So thanks again from the bottom of my heart for, again, it's like an arbitrary social media number, 200,000 people, but think about 200,000 people in a room. They can't all fit in a room. Think about your high school class, your college class. Probably smaller than 200,000 people. So really just mind-blowing stuff. And once again, I just can't express enough how appreciative I am of all of you being a part of it. So that's it from me. Hopefully that wasn't no tearjerker for me, but maybe it was a tearjerker for someone else out there. Anyways, I'm going to shut up and enjoy the rest of my day, and hopefully you are going to stop listening and enjoy the rest of your day as well. See you at 8 a.m. on Monday morning. Have yourself a green and fantastic trading week, and as always, I will see you in the next one.